My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, we're going to demonstrate how to account for leases. Actually, this is a two-part video series here. The first tutorial here is going to introduce how to account for operating leases. And then the second tutorial is going to take the same data with a little bit of modification and demonstrate how to account for capital leases. So let's get started. Okay, so in this video we are going to talk about capital and operating leases. Let's take the first example, or the first set of data here. We have a company, Lease that is going to lease some computer software, and we've got the basic terms of the operating lease here. It's a 2-year operating lease agreement. Contract calls for 4 rent payments of $10,000 each, with the payments being made semi-annually, June 30th and December 31st. So we're entering into this lease agreement on January 1st, and then we will make 2 lease payments in 2013 of $10,000 each, one on June 30th, one on December 31st, and then we'll make a second series of lease payments in 2014, again on June 30th and December 31st of $10,000 each. The computers were acquired by Computer World at a cost of $90,000, expected to have a 6-year useful life, and then Nathan Langstrom's cost of capital is 6.5%. So we'll have to deal with all of these various pieces of data and various elements of the problem as we go along. Our first step is to go through the measurement process. Is this an operating or a capital lease? The second step then is to recognize the transaction appropriately by way of journal entries, and then finally is to make sure that we get the proper disclosure. In particular, we are focusing on the balance sheet disclosure, although there's going to obviously be an income statement impact as well. Alright, so first step is then this measurement issue. Is this an operating or a capital lease? So we're going to go through each of the 4 criteria. Remember, the 4 criteria are, does title transfer? Is there a bargain purchase option? Is the lease term greater than or equal to 75% of the useful life? Or are the present value of the lease payments greater than or equal to 90% of the fair market value? Alright, so the first question then is, does title transfer? If you recall back at the data here, we'll go back to that slide, there's nothing in here that suggests that title transfers. We cannot infer title transferring in an asset. That would be contrary to what we would have as expectations of a contractual agreement. Title does not transfer unless we explicitly state that it transfers. So there's nothing in here that suggests that title is going to transfer, so we answer no to that question. Second question is there a bargain purchase option? There's no mention in the data set that Nathan Langstrom has the ability to purchase the asset at the end of the term or at any point during the lease, and so there is no bargain purchase option. Once again, that was something that would have to be explicitly stated in the terms of the contract. So if the contract doesn't mention anything about a bargain purchase option or a purchase option at all, then there is no bargain purchase option. So we answer no to that question as well. The third question, which is where we begin to get into a little bit more of analysis, is the lease term greater than or equal to 75% of the useful life of the asset? Well, again, we go back to the original data here, and we can see that the lease term is for 2 years. We've got a 2-year lease agreement, and the expected useful life of the asset is 6 years. And so the answer to the question is 2 out of 6 greater than or equal to 75% is no. 2 out of 6 years is only 33%, which is clearly less than 75% of the expected useful life. In essence, we are simply not making use of a major portion or a significant portion of the life of the asset. Well, the asset has a 6-year life. We're only using it for two out of that 6 years, and so we answer no to this particular criteria. The fourth criteria is the present value of the lease payments greater than or equal to 90% of the fair market value of the asset? Well, here's where we have to go into some of our computations. So we know that we have payments per year of 2, right? Payments are made June and December each year for a total of 4 payments. The payments are $10,000 each, and the interest rate per year is 6.5%. We can go back to the original data in the problem, and we've got 4 rental payments altogether of $10,000 each. This is payments being made twice per year, and our discount rate or our cost of capital is 6.5%. So based on that information, we can determine the present value of the lease payments. So let me bring my calculator in here. And by now you should all be familiar with how to deal with present value computations. First thing is to hit the second or the shift key and clear TVM. Make sure that I'm not accidentally combining data from different problems. Second step is to make sure that I've got my payments per year set up correctly. Payments per year is 2. So mine's already set up at 2. If yours is not, you simply, in this menu path, select 2 and hit enter, so that payments per year is equal to 2. Hit the clear button a couple times to clear out the screen, and I'm set up. So my payments are $10,000 each, and remember I insert cash outflows as negatives. I'm going to be making 4 of those payments, and my interest rate per year is 6.5%. So I type in 6.5, interest rate per year, and then I can compute the present value, and we see that the present value is $36,950. The question is that 90% or more of the fair market value? And the answer is clearly no. $36,950 is only 41% of the fair market value. And so we're clearly less than 90%. So we answer no to this question as well. Since we have answered no to all 4 questions, we have an operating lease. Remember that the principle underlying this analysis is substance over form. Is the substance of the transaction a purchase, or is it really truly a rental? If we answer no to all 4 questions, then it's really truly just a rental of assets and is not hiding itself or being obfuscated as a purchase or as a lease, but masquerading as a purchase. So we have an operating lease, and the accounting or the recognition of operating leases is actually quite simple. So on January 1st, remember that's the inception of the lease, nothing happens. There is nothing to recognize. There's no asset, there's no liability, there's no cash flow in this particular structure. Nothing happens on January 1st. On June 30th and December 31st, all we simply do is credit cash for the $10,000 payment and debit lease expense or sometimes rent expense for the same amount. That's it. So accounting for an operating lease is very simple. There is no balance sheet disclosure. These transactions did not do anything to an asset other than cash, but we didn't capitalize the equipment that we're renting, nor did we recognize any sort of liability. And so there's nothing to disclose in terms of the balance sheet. That's why operating leases are sometimes referred to as off-balance sheet financing, because we get the use of an asset without having to recognize it on our balance sheet. The income statement impact is pretty straightforward. It's just the sum of whatever our lease expenses are. In this particular case, $10,000 for 2 payments this year, and that's $20,000 of lease expense as a part of the operating costs for the year. And that's all there is to accounting for operating leases. In the subsequent video tutorial, we're going to take the same basic data, modify it just slightly, and deal with the measurement, recognition, and disclosure of a capital lease.